think you have here. You have three here. Maybe it's too small. It's 415.
415. Yeah, okay.
You wait.
Of course, you don't. You're Italian, so don't stand
Don't say so.
That is terrible. Have you thought of So we work a lot with the on Sunday, for example, we partner with this okay. This okay.
Good afternoon. A few words before the keynote lecture of Professor Konstantinides. As you might have noticed, we are pushing the technological frontier further and further in this EFMA. We already have a wonderful app, and we are also using an online platform for collecting questions. So the link that you can see on the screen is the link you can visit from your mobile phone to post questions that will be raised at the end of the session. Just to show you how it works, if you type pigeonhole.at from your mobile phone, then you're going to type EFMA 2018 Milan as a passcode. And this takes you directly to the sessions of this conference. The session that is about to begin is the keynote lecture number 3. If you click on enter this Q&A, you can type your own questions here. You have to insert your name, and this is the only data that is actually required to post the questions. And afterwards, you can type your question that will be, at the end of the speech, delivered to the keynote speaker. Thank you.
So, good afternoon. Actually, it is a pleasure for me to be here today, and actually in this room, where exactly 23 years ago, I did my thesis actually here in banking and finance. So a lot of time, but it's always a pleasure. So I would like also to start in thanking Dean Elena Beccali and the entire organization committee for having invited me here today, and have the honor to introduce the speech of Professor George Konstantinides. Actually, searching for a parallel between what information drive asset price and the asset management industry, which is where I'm working actually, I landed in factor investing. Factor investing is an investment approach originated with a research paper by Stephen Arden in 1976 on arbitrage pricing theory. And since few years, this argument became very relevant in our environment due to the macroeconomic situation in which we are. Factor investor, or factor investing, is an investment approach that involves targeting quantifiable factors that can explain different in stock returns. To understand the driver of market valuation over time is a key input for capital market expectation, and that information feeds the asset allocation model that we adopt to create investment solution as asset management. It is also relevant to understand that might be not linearity in the payoff. In one example that Professor George Konstantinides shows, that the moving to better economic environment will help futures returns. And as getting pricing might become a drag on expectation. We, as a leading global independent asset management company, find the same thing in implementing factor investing. Value works, but at the end of the day, stocks are cheap for a reason. And this is why we explore the quality and the filter, and therefore the factors of those stocks when we rely and when we implement portfolio. Last, Professor Konstantinides used 300 more macro variables. We, as a company, use big data and machine learning, but actually grounded in a behavior theory, more explicitly or more concretely. We currently work on natural language processing of earning call transcripts and classifying the sentiment and the tone in order to characterize the way people are talking, in order to understand the way they manage the company. So this is how, starting from valuation, but leveraging artificial intelligence and blockchain, we are discovering a new frontier in investment management. So now it's the time for me to leave the floor to the professor.
Good afternoon, and thank you. I guess the trick here is I'll talk slowly because this room reverberates, but at the same time not so slow that I put you to sleep. So, first of all, this is joint work with my co-author Anisha Ghosh, and the topic is what information drives asset prices. Now, this is, unlike what it says at the bottom, keynote address. Correction, it's a lecture, it's not a keynote address. And which means that please ask questions as we go along. You don't have to wait for questions at the end, so I welcome questions during my presentation and at the end as well. My starting point is we know that investors look at signals around, and they look at a lot of information about the macroeconomy in the United States. There is the periodic revision of the macroeconomic variables. There are about 125 macroeconomic variables, and the question is, investors have information, much more information, of course, than the macroeconomic variables. They read the newspapers for political developments, economic developments, business news. And the question is, how do investors cope with this vast amount of information? And in particular, to narrow it down, is which macro information they pay the most attention to. Now here I have to qualify. We cannot tell exactly which information they look at, but what we are looking at is which macro information is the best summary statistic of all this vast amount of information that they look at. In the macrofinance literature, earlier models focus on a limited number of macroeconomic variables, and as I'll show in a figure very soon, they look at consumption growth and GDP growth and apply a filter, sort of apply mathematical methods, Bayesian methods, to extract from that signal information about the state of the economy. You do not observe the state of the economy, we assign a probability, and in general we use the signals to update our probability of the economic conditions. Now, as I'll argue, these models fare poorly in explaining many things, and they fail to explain the high historical equity premium, which is observed not only in the United States, but historically in all the G7 countries. The low risk-free rate, the high variability of the price-dividend ratio, that's a key one, because by now there are many models that explain the first two, the high equity premium, to which you were sensitized in the early days by the Mera and Prescott, and the low risk-free rate. So by now we have models that explain those. but most of the existing models do not explain the high variability of the price-dividend ratio. That's the third arrow. They do not explain the low correlation between the price-dividend ratio and consumption growth, and do not explain the low predictability of consumption growth by the price-dividend ratio. So these are some of the challenges that were partly solved but not completely solved by earlier models. So just to give you an overview of what we do, and then I'll discuss the model in detail, we sort of start by looking at the consumption process and the dividend growth process, and we allow for consumption growth to have different mean, so expected growth in different regimes. And for simplicity, we have two regimes. Of course, the economy cannot in general be sort of explained neatly by having two regimes, good and bad, but sort of we want to have a very simple model, so allow for two regimes, the good and the bad regime. Of course, we do not observe in which regime we are, and that's what investors are trying to add information, the probability of being in the good regime. So they have consumption and dividend growth processes have different means in two regimes, latent regimes, which means that there's two regimes we do not observe. So each period, the investor rationally updates the probability that the economy is in the first regime by observing the updated history of consumption growth and an additional signal. Now, as I'll show, sort of consumption growth is a totally useless signal, but we keep consumption growth in addition to another signal so that our model nests the earlier models that had only consumption growth as the signal. And the model explains the equity premium, risk-free rate, and excess volatility puzzles, unlike learning from consumption history alone, and I list again all the things that it explains, which some of the earlier models failed to explain. Okay, so I'll talk a little bit about earlier work, the literature review, and then investigate what is the signal and present the model, the data, and the results, and the interpretation of the economic regimes, and also talk about the real and nominal term structure of interest rates, and then provide a conclusion. So there is a lot of literature about learning about latent states or a single parameter, but as I said, when they start incorporating that information in the model, typically these models assume that the signal is either consumption growth or dividend growth. And there is a broader set of models which assumes that not only do we not observe the true economic regime, but we do not also know what is the correct model and the parameters of the model. Those are known as model and parameter uncertainty. I'm not going to do that, because I want to show that even if investors know the model and know the parameters of the model, just allowing them to not to observe the actual state of the economy and learning from some signal, we can go a long way in understanding these stylized phenomena about the markets. So the model belongs to the last class of models, long-run risks models that were introduced by Bansal and Yaron, and which allow for some shock that sort of is persistent. That's the key. It's persistent, and the persistence sort of affects the equilibrium and the prices and the interest rate and the market return if one has so-called Epstein-Zinn preferences, which are preferences which sort of favor the early resolution of uncertainty. So something that is shock that has long-term implications affects prices to a large degree. Okay, so So what is the signal? We find, yeah, I'll show you a figure below, but we find that of all the relevant, about 125 macro variables, there are two classes of variables that are most highly correlated with what investors pay attention to. And when I say pay attention to, means affects the aggregates in the market, most importantly, the price-dividend ratio of the market. So I'll first discuss the US, and then I'll look at the G7 countries as well. And we find there are two classes of macro variables that are the best summary statistics of the information that investors look at. The first one is price level variables, the consumer price index, the producer price index, and a bunch of other variables that are measures of the price level. And the second one is labor market variables, and here we have quite a number of them, hourly earnings, hours of production, number of employees in different sectors, and so forth. And so before I look at the other bullets, let's sort of look what we did. So as a starting point, and this is what I advise anyone who does something to start by looking at the data. So what we did here, we did nothing very fancy econometrically. We just ran univariate regressions of the price-dividend ratio of the market in the US against each one at a time, of all these 125 macro variables. And for each regression, we recorded the R-square of the regression. And these columns represent the R-squares. I do not expect you to be able to read the letters there, but the first column, the high column, this one on the right, those are all variables related to price level. And you see that all of them have a very high R-square. So we can interpret that as saying that the innovations in this price level summarizes. We do not know exactly what is in each investor's mind, but these simple regressions summarize what is a good sufficient statistic of all the information that affects prices through the perception of investors. So all those have very high R-squares. The top number of R-squares there is about 70%. We use the consumption price index later on because it is a very common number. What we call as inflation is the consumer price index, the CPI. And that has a correlation, that one there has a correlation of about 60%. The second grouping, going to the left, the second grouping over there is all different measures of labor market activity. And the highest point, the highest column, is the highest correlation is the earnings per hour in the economy. And all the other columns in the group are variations of labor market variables. So you see that if I were to look at all these variables and try to make some sense, the information that investors look at are information about the inflation and about the labor income. And of course, that has a very common sense interpretation. When the economy is in a recession and is beginning to improve, then the labor market heats up. There is pressure on wages and on raw materials, and inflation increases. So it's generally understood that there is inflation picking up, increases when the market is improving. You may say, well, what happened, at least in the United States, after the financial crisis? The economy started improving and has steadily improved since 2008 to the present, and we have not had much inflation. So be careful about making general statements about inflation. In most cases, inflation is a signal that the market is improving, but it has problems, and we'll address those problems. The second one, again, is obvious. When the market is improving, there is pressure on wages, and wages go up. Again, that did not happen after the financial crisis for all kinds of reasons. Maybe firms had overcapacity, maybe they replaced workers, unskilled workers, with robots, but so there's a structural change in the economy. But if you look historically, at least, and we'll revisit this problem, the best signals that the economy is picking up is inflation and wages increasing. Now, how about the rest? We said that most earlier models look at consumption growth as the signal from which the market learns. The consumption growth is somewhere there. So that's a lesson to all you people that do research, that before you start building models, just look first at the numbers. Don't build a model where the signal comes from consumption growth, because consumption growth does not affect the price-dividend ratio. It's down there. If you're going to be a model, look at variables that we see that historically have affected the price-dividend ratio, inflation and earnings per hour. Even though we said there are problems, these have not shown up in the recent recovery in the United States from the financial crisis. So we're going to build a model that we are using this, but before we do that, you should have some reservations here, because these are levels against levels, price-dividend ratio against some of those numbers which are very persistent. So we repeated these regressions. I do not show it here in first differences, and we get very much the same ranking. The R-squares are a little lower, but the ranking is exactly the same. The most important innovations, as reflected in changes in the price-dividend ratio, come from innovations in the consumption price index and labor market variables. So let me go back one slide here. Going to the second bullet, intuition, these macro variables are persistent, but so why is it then that our model that incorporates those seems to work much better in matching all kinds of things in the economy? And the second bullet gives us the intuition. These macro variables are persistent. CPI and earnings per hour are persistent variables, which means that combined with Epstein-Zinn preferences that looks long in the future, sort of have a big effect in the economy. But consumption growth is not persistent, so consumption growth could not do the trick. Okay, and we have some independent evidence. It's not just the running regressions. Look at the third bullet. These are the two classes of macro variables that Bloomberg uses, and we have information, what information Bloomberg users use at. Bloomberg users pay the most attention to according to fact set. So there's actually evidence that investors who look at the macroeconomy to forecast and invest look at this set of variables. So he said I can have the same kind of regressions if I run it in differences. So first bullet, similar results obtained when the regressions are run in first differences. Second, high negative correlation of the price-dividend ratio with inflation across the G7 countries, except Italy. Well, Italy is different. And also, the third bullet, high negative correlation of the price-dividend ratio with hourly earnings across G7 countries, except, again, Italy, but also Japan. But sort of the it's always useful if you do something in one country, and we tend to look at the US, the most dominant economy, to worry a bit that sort of we over sort of search in one database. So it's always good to look across different economies, and this, we have, I said, 2 exceptions here, but in general, these general results hold across countries. Okay. Now, R squared, but we said inflation is an unreliable signal. The negative correlation of the price-dividend ratio and the inflation turns positive in some subperiods, and you have all this funny behavior in the United States following 2008. Therefore, we try to look at sort of some more general information. So what we do is look at all these 125 macro variables and do a principal component analysis. Actually, we use the results of a principal component analysis by Sydney Ludwigson. She has on her website all these principal components, which essentially the first principal component is sort of the one variable that summarizes most of the variability of these 125 variables. The second principal component, the next after we remove the variability based on the first one, and so forth. And if you look at the third bullet, the R squares of the price-dividend ratio on the first 6 principal components are all very small except the second principal component, that is 49%. And of course, we can look at what are the components of this principal component, and you will not be surprised to find that the second principal component loads heavily on price level and labor market variables. So it's what we saw on each one, but the principal components combines in an optimal way all the signals, and is driven primarily by inflation and labor market variables. And what is more important, if you look at the bullet one before last, the correlation of the price-dividend ratio, the second principal component, is negative in all subperiods, which is, so you don't have the problem that is positive, and sometimes it gives one signal, and other times it gives a different signal. Therefore, for the results that I'm going to present today, we adopt the second principal component as our signal, and but if you go to my website and look at the paper, we also show the results replicated using other signals, specifically the CPI and the earnings per hour. Do you have any questions so far? No? Okay, so to outline the model is an standard exchange economy, a Lucas exchange economy, kind of economy. We don't focus on production. We use Epstein-Zinn preferences. For those of you who are not familiar with it, it's kind of preferences that sort of pay a lot of attention to even a small shock, but a shock that has long-term, persists in the long run, and therefore through this type of preferences, investors care a lot about these very persistent shocks to the economy. Third bullet, the investors know the model and its parameters, but do not know the current regime. There are 2 regimes, call them 1 and 2. 1 is the good, 2 is the bad. We do not observe the regime, but we observe a signal history at time t. Investors use rational methods, the Bayes rule, and calculate the probability that we are in the first regime. Okay, that's the guts of the model. So how does it differ from the Bansal and Yaron model that sort of has been very successful in some respects, but not so successful in others, is that the regimes are not observed, unlike the Bansal and Yaron model that at any point in time we observe the regime. So that's not a learning model. So this simple change has a lot of implications. So here is a little bit, this is probably the only equations you'll see in this presentation. So aggregate consumption is the first equation. The change in consumption. Therefore, the consumption growth it has a mean and has a volatility. And the important thing is that the mean there is different in the two regimes, while the volatility is the same, whether we're in the first regime or the second one. And likewise, the dividend growth has the expected dividend growth, therefore the mean, is different in the two regimes. And again, the volatility is constant. So, second bullet, the volatilities are intentionally set to be constant across regimes. In other words, we have homoscedasticity here. Unlike in the Balsan and Garon model, probably there is heteroscedasticity, but again, we want to have the simplest model and see how much mileage we get from a model that allows for this simple idea in learning that we do not observe the two regimes, and we learn, we update our probability every period based on the signal. And the state is a Markov process, so it sort of jumps, either remains in the same regime or moves to the second regime with some probability. Of course, here we assume that the investor knows the probabilities of moving, but not observe the state at any point. Now, you said this maybe is a little simplistic to allow that the economy can be characterized by two regimes, and we're actually working now on having 4 regimes, which is much richer model. But again, I want to see how far we can go with this simple model. Okay. Now, I'm not going to go through the technicalities, but we can solve the model numerically and through value function iteration. And here the only thing I want to mention, for those of you who read the Campbell-Schiller models, they sort of make an approximation, they log linearize their models. And here we also try to log linearize it as an approximation, and it turns out to be a very bad approximation. So I warn you, if you are working with this kind of models, before you log linearize them, to try the hard way and sort of avoid the linearization and estimate them and solve the model numerically. Is kind of very slow, but this day and age with fast computers, it can be done in a couple of days. The whole thing can be estimated in a couple of days. Okay, so we estimate and solve the model, and we have some targets on the moments of consumption growth, dividend growth, risk-free rate, price-dividend ratio, market return, and our signal, which for the results that I'll present today is the second principal component. The data description is publicly available information, free information to everybody except the CRISP database. You have to be a subscriber. Everything else is free. I won't go through the data description. So the model has 15 parameters, and we target 22 models, and I'll sort of list them. The mean, variance, and first order autocorrelation of consumption growth, dividend growth, second principal component, market return, price-dividend ratio, risk-free rate, and all the cross correlations between those. And let me just highlight the moments that people did not either did not pay enough attention to, or did not target, or their models do not explain well, is the moments of the price-dividend ratio, and also the correlation between consumption growth and the price-dividend ratio. We saw from those histograms that's very low. And the other models, which sort of either use no signal or they use consumption growth as a signal, essentially force a very high correlation between the price-dividend ratio and consumption growth. For example, in the habit model of Campbell and Cochrane, where the only driving variable is consumption growth, that implies a correlation between consumption growth and change in the price-dividend ratio of about 50%, even though you saw from the histogram that that's about 2%. So if that's the only information, the only shock to the economy, then it will have to have a high effect on the price-dividend ratio, which is counter to what we produce. But here you'll see that we do a good job with at most of these models. And we estimate the model with the general method of moments. And then I'll show you some results. So there are 4 panels here for the annual data, 1964 to 2011. Actually, we extended now to 2014, but so that's the results I'll show you. So I'll take one panel at a time here, and counting that, can you see those numbers? No. And I always get upset because when someone presents a table like that, they discriminate against the older members of the audience. So I will not sort of challenge you here. I see some older members of our profession who are sitting up there, so they try to tell us that they can see what's going on. So I'll take one panel at a time, and assuming that you cannot read the numbers, I'll just go through the bullets. First, look at the moments that we are targeting. The first one, bullet says, it matches the mean and volatility of consumption growth. Now, the autocorrelation of consumption growth is close to 50% in the data, and we do not match that. But that's good, because consumption growth is not estimated very accurately, and it is sort of a manipulated number. It's a residual, actually. And if indeed that number of 0.475 were correct, then when you see at the 2-year and 5-year autocorrelation, it would still be very high. But by the time you go to the 2-year autocorrelation or 5-year autocorrelation, is essentially becomes 0, which says that is something artificial about the way that the data is reported, that is that high correlation. So it does not bother me. In fact, I think it's good that the autocorrelation in the data is 0.02 and is not the 0.475. So I think, which is, I think, is better. Third bullet, it matches the correlation between consumption and dividend growth. That's not a big thing. Fourth bullet matches the low correlation between consumption growth and price dividend ratio. And that's something that most previous models fail. In particular, the habit model of Campbell and Cochrane, where the only driver in the economy is consumption growth. By construction, that correlation in their model is 50%, which is very different than what you observe in the data. The data, that correlation is very low. It matches the low correlation between dividend growth and the price-dividend ratio, similar to what I said before. But it misses the mean and volatility of dividend growth and the autocorrelation of dividend growth. Again, that doesn't bother me because dividend growth is a manipulated number. We know that firms try to manage their dividends. They never want to lower the dividend, and they're careful about raising their dividend because they do not want to have to lower it later on. So it is a smooth number. And that's why in the data, the autocorrelation of the dividend growth is high, but is lower in the one implied by the model. Okay, going to the second panel, looking at the prices. First bullet, it matches the mean, volatility, and autocorrelation of the risk-free rate. Matches the mean, second bullet, matches the mean volatility and autocorrelation of the market return. So it explains the equity premium puzzle. It explains the low risk-free rate. and also looks at matches their volatility and autocorrelation. And the third bullet is the most significant, which many models sort of are challenged. It matches the mean volatility and autocorrelation of the price-dividend ratio. The volatility is the one. I'll show you that if I remove the second principal component as the signal and leave as the only signal the consumption growth, the model implies that the price-dividend ratio has close to zero volatility. And that's an important challenge to many related models. And here we managed to get a price-dividend ratio. If you don't see the numbers, I'll tell you what it is. It is in the data annual 0.415, and the model implies 0.450, so matches it almost exactly. Then let's go to the last panel, the third panel, the second principal component. It matches the mean, autocorrelation, and correlation, the price-dividend ratio. So it is the important signal. Even though we give the model a chance, we have two signals. We have the consumption growth and the price-dividend ratio. It has a very low price-dividend ratio, very high, low correlation with the consumption growth, which is what you observe in the data, but it has a high correlation with the second principal component, and which is what provides the signal. And the last panel gives us the parameter estimates. So there are many parameters, but look at the first bullet. Essentially, remember, we allowed the conditional expected return of consumption growth to be different in the two regimes. When we estimate the conditional expected consumption growth in the two regimes, you cannot see the numbers, but they are here. They are this difference compared to the volatility. Oh, no, so that's the dividend. Here, this 0.015 and 0.0110 compared with the volatility of the consumption growth says that the conditional means are practically the same, which means that if I observe the consumption, the realized consumption growth, that does not give me much information about the state of the economy. So consumption growth is not a signal. On the other hand, if you look at the mean differences, the means, conditional means of the second principal component, 0.746 minus 2.661, they are very different, and that also says that through the investors, the price-dividend ratio is affected by the realized value of the second principal component. So that's consistent with our intuition, and so this is what we find. So the second bullet, the second principal component, is very informative, very different means in the two regimes relative to the volatility. And the model also makes sense. The higher means of consumption and dividend growth in the first regime, that's the good regime where we expect consumption to grow and the dividends to grow. And when you look at the autocorrelation, the probability of transition, it says that the regimes are persistent. So if the probability of regime 1 increases, we expect that to have long-term implications, which is, we said, is a key consideration in that change in the probability having a big effect in the market prices through the price-dividend ratio. And finally, I will not go through all the parameters, but the risk aversion coefficient is reasonable, is about 15, which is pretty standard in most of these models. And the intertemporal elasticity of substitution is about that's 1.6, which again is reasonable. Okay, so this model does reasonably well in explaining things, and we have repeated this by replacing we always have consumption growth as the first signal, but you also have similar tables, which are in the paper you can find on my website, where we replaced the second signal, instead of being the second principal component, to be the inflation or the earnings per hour, and we get very similar results. But you want to contrast this now with a nested model, one in which we have only one signal, consumption growth. And you'll see that that model does not do well at all. Again, these are the different panels, and let me assuming you cannot read the numbers here, let me interpret it. And the model fails in key dimensions. Essentially, the volatility of the price-dividend ratio is practically zero, fails to explain the excess volatility puzzle. Because so many other models do not explain that, it's called a puzzle, the excess volatility of the price-dividend ratio. Going back to the table, the volatility of the price-dividend ratio is in the data is 40%, 0.4, and the model implies volatility of 0.003. So it really fails in one very important dimension. So the autocorrelation of the price-dividend ratio, the model implies to be 0.2 as opposed to the data, which is 0.86. And remember, the main model does explain that as well. Now, look at the third bullet. Since the model tries to think of consumption growth as the only signal, sort of, it tries to fit the consumption process to have very different means in the two regimes. And looking at the third bullet, this model estimates the consumption growth in the second regime to be minus 5.7% annual consumption, and that's a consumption that has not, consumption drop that has never been observed in the US history, even during the Great Depression. Okay? So because it's sort of striving to fit the stock market and bond market data as a signal coming from consumption growth. So it gives this unrealistic, very different means in the two regimes. And another thing that you'll see later on is says pro-cyclical market return, which means that this model implies, I'll show it when I show you some figures, that when we think are in the good regime, then this model says that the expected market return is high. And what you observe is the opposite. If we're in a recession, the interest rate is low because all the money shifts from the stock market to fixed income, flight to safety, and but the stock prices are low, and we expect them to go be high in the future. So in the recession, the interest rate is low, and the expected market return is high. This model, this alternative model, says the opposite. That when the market is, the prospects are good, the interest rate, the expected market return is high, and when we're in a recession, the expected market return is low. It's exactly the opposite of what we observe. Okay. So once you solve the model, and knowing there are things we observe, the interest rate and the price-dividend ratio, these things we observe. We don't have to estimate in every point, every year. Then from there, we can back out the probability of being in the good regime as perceived by the investors. Because it's the investors that set the price-dividend ratio, the investors that set the interest rate. And therefore, we'll sort of show you a series of figures based on, at every point in time, what they invest based on the beliefs and what that implies about all these market quantities. How much time do we have? Now? 30? Half an hour, okay, good. So the beliefs process, so the horizontal axis, first let's look at the red line. The horizontal axis is the probability of being in the good regime. Starts from 0 probability up to 100% probability. And in all these learning models, if the probability is very close to 0, then I more or less know what the probability is going to be next period. So the volatility is low, so it starts with low. When the probability is very close to 100%, again, there is not going to be much change. The highest uncertainty, and that's a feature of all the learning models, is that the highest uncertainty is when I'm somewhere in the middle. Okay? When a body in the middle can go one way or the other, there's the highest volatility. And that's what you observe in the red line. When I'm about in the middle, then the conditional volatility, so what I show there is the variance of the probability next period, conditional on the probability today. That variance is highest when I'm about in the middle. And that will have all kinds of implications. Now, of course, the blue line is the alternative model, and as I said, all the learning models have this general feature. When you are most uncertain, so about 50% probability of being in the one or the other state, that's when the volatility is highest. So the blue line is similar. So far, it's a draw. So to summarize, there's high uncertainty about the future when the probability is about 50%, and that declines as the probability approaches the 0 or the 100% boundaries. Okay, so let's see what that implies about the risk-free rate. Again, the main model is the red line. The highest uncertainty is when we are about in the middle. It's not exactly in the middle, but sort of away from the two ends. And then that's when there is the highest uncertainty, and that's when there's flight to safety, and investors move from the money from the stock market to treasuries. While you see the alternative model sort of completely misses the point, okay? When the probability, is valid. When the probability of being in the good regime is very low, that's where we are in the recession, then the interest rate is low. So it catches that, but it's sort of monotonically increasing. So to summarize, the main model implies that the risk-free rate is U-shaped. At intermediate probabilities, the uncertainty is highest and the interest rate is low, what we call flight to safety. In the alternative model, the risk-free rate is monotonically increasing. So here, again, so far there isn't sort of, you can say the one model is better than the other, but you'll see the following results. And here is kind of the shocking result. The red line says that as the probability of being in the good regime increases, the stock market is higher, for the price-dividend ratio is higher. That's the red line, the main model. While you see the blue line says that the price-dividend ratio is essentially constant. Whether we are in the good regime, the high probability of being in the good regime or low probability of being in the good regime, the blue line says there is no action in the price-dividend ratio. We saw that also in the tables when we said that the alternative model does not generate misses by a great deal the volatility in the price-dividend ratio. It is practically constant. And that's sort of the main challenge of all the models, and the alternative model does not address it, where you see that here is very sensitive to the probability, and you also saw that through the table that it matches very closely the volatility of the price-dividend ratio. So that's one of the main successes of the main model. Okay, so we said the price-dividend ratio is sharply increasing. The alternative model, the price-dividend ratio is flat because the current beliefs are not very informative about the future. Okay, if consumption growth, as you know in the data, so the innovation in consumption is not very informative about the data, so it's a bad signal, then whatever the consumption growth is, it doesn't tell me anything, so it does not allow the price-dividend ratio to vary very much. Okay, here is the expected market return. And again, as you would expect, if we are somewhere in the middle, that's when there is most uncertainty as to what developments will be in the economy, and the equity premium is the highest. So the expected return is highest, not when the probability is very close to 0, very close to 100%, but somewhere in the middle. And the blue line, the alternative model, says that it's monotonically increasing, which is also not what, that's not what is happening. Now, here I show the figure, the expected market return is a function of the probability. But usually when you try to use the price-dividend ratio to forecast the market return, which is something you normally do, we'd like to see what this graph looks like when you plot the expected market return not on the probability, but on the observed today price-dividend ratio. And that's what I do. Okay, I'll do it next. But sort of here I summarize what you have shown. Uncertainty about the current regime is highest when the probability is away from its boundaries. Okay, so now here is a graph of the expected market return, but not on the probability, but as a function of the price-dividend ratio. And you see that even though most of the time we run a linear regression, trying to use a price-dividend ratio to forecast the market return, and we have the unsettled issue that sometimes for some subperiod it forecasts it, and in some other subperiods it does not forecast it. And here, so that we have an explanation for that. Is because the relationship is not monotonic. The expected market return is highest when the probability is about in the middle, where also the price-dividend ratio is the highest. So here is to summarize. The expected market return is strongly concave in the price-dividend ratio. These patterns are like the common practice of predicting the market return with the price-dividend ratio in a linear regression. In the alternative model, I do not even show it. You see, it's something on the side, that blue line, because essentially the model says that there is no variability in the price-dividend ratio in the model. Okay. The market return variance, again, the alternative model, the blue line, says the variance of the market return is pretty much constant, okay? That's why you see that is very far from matching the data. While the red line, the main model, says that the variance of the market return is highest when the probability is about in the middle and can easily go down or go up. Again, that's what helps match the moments of the market return. So uncertainty about the current regime is highest when the probability is away from its boundaries, and therefore market return variance is highest. In the alternative model, the market return variance is flat in the probability, okay? And that does not match the data. Now, I could sort of show you, but it's not necessary to show you variations of this model where the signal is not the second principal component, but consumption growth or the earnings per hour. They're in the paper. I'm not going to show them, but essentially they tell the same story. So I'll not do that. Now, here we tried a kind of a very challenging exercise. I'll return to the table in a minute, but essentially let's look at the first bullet. We estimated the model without explicitly trying to fit the term structure of interest rates, the 1-year yield, the 2-year, the 5, the 10-year yield. We go up to 30 years. So that's a real challenge to the model, because here we sort of try to find the parameters to match things about the stock market and the 1-year interest rate, but not about the 5, 10, 20, 30-year yield. And so here we say, suppose we use those parameters to see what the model implies about the term structure. And we want to see what happens to the nominal and real term structure. Okay? And the first row is the average. So first we look at the nominal yields. And so what you observe on average is that the nominal term structure is increasing. The yield of the 10-year bond is typically higher than the 1-year bond, and 20-year bond is higher, and so forth. It is mildly increasing. So the first row shows us the mean, and so I'll skip the volatility. The mean observed from 1964 to 2013. The second row, these numbers, give us the model implied average nominal yields. And even though we're not even trying to match those things, the numbers are very similar. So this is a challenging task because we are not even trying to find parameters to match that. And again, they show that the term structure matches the nominal observed one on average very closely and is mildly upward sloping. Okay? Then we go to the real yields, and we estimate the real yields based on inflation-adjusted bond prices. So the real yields, which is this line, says that in the data, the real yield curve, inflation-adjusted, okay, based on inflation-protected bonds, is upward sloping. And again, that's a big puzzle big challenge in finance, because most of the models imply that the real yield curve is downward sloping. And here we find that that's not the case. Well, it did not quite match it to be increasing, but at least it is not decreasing. So here is the model implied. It's actually pretty flat. So it is one step ahead of other models that imply that it is decreasing, and that's kind of a challenge. So to summarize what we have about the term structure, and here I admit that this paper was not intended to study the term structure. We're working on that in more detail, but just looking at the average nominal and real yields and we see what the model implies about the average nominal and year yields, well, we think that, that's a good job. We said this is a challenging test because the yields beyond 1 year are not targets in the estimation. For all maturities, the model implied nominal yields closely match the data. More importantly, for all maturities, the model implied real yields closely match the data, a feat that eludes many alternative models. Here I have to say, closely fits in the real, in the sense that it is flat, but at least it does not have the embarrassing feature of many other models that imply that the real term structure is downward sloping, which is contrary to the data. So here I'm going to summarize and leave time for discussion if you like to have questions. So the poor performance of some macrofinance learning models may be driven by the assumption that investors learn from the consumption history alone. We present a model of a real exchange economy with rational learning about the economic regime from the consumption history and the second principal component, or similarly using the CPI growth or earnings per hour growth. And the model, unlike the learning from consumption alone model, rationalizes the high equity premium, low risk-free rate. We said those kind of challenges were identified many years ago, so by now most models address the first two bullets, so that would not be much of an achievement. But the third one is very important, the excess volatility of the price-dividend ratio, which is something that most other models do not address. The fourth bullet, dynamic behavior of consumption and dividend growth rates and returns across economic regimes. Remember, the alternative model had that in the bad regime, the expected consumption growth is minus 3.5%, something that has never been observed in 1 year in the US history. It addresses the low correlation between the price dividend ratio and consumption growth. We saw it clearly in the data that consumption growth is not a signal that moves the price dividend ratio. The alternative model has a high correlation, contrary to the data. The main model finds that that correlation is very low. One before last bullet, the low predictability of consumption growth by the price dividend ratio, because the conditional consumption growth is very similar in the two regimes. It's only on the alternative model that it tries to force consumption growth to be a signal, estimates very different conditional means. But that's not what you observe in the data. And also the final thing, we took a first look at the nominal and real term structures, and on average it addresses, matches both the nominal and, more importantly, the real term structure, which is mildly upward sloping, and our model says that it's at least is flat, but that's one better than alternative models that predict that the real term structure is downward sloping. So thank you very much for your attention, and I'm open to your questions. Do you want me to sit down or stay here?
Oh, you can stay here. Okay, these are the question. You can pick whatever question you want.
Now I'm challenged. 3 votes. 3 votes means 3 people ask that question. We start from the top. Can you read it? I'll read it. It gives me time to think too. Could it be argued that the labor market-based information captures the state of economic productivity, efficiency? You did that? You did the trick? Okay, good. Could be argued. Okay. Yes. I cautioned you that the normal channel is that the economy is picking up. There is increasing demand for labor, and wages go up, and that's one of the channels, along with increase in in the price of raw materials, that causes inflation, and these are signs that the economy is picking up. Now, this question says, could it be argued that the labor market-based information captures the state of the economic productivity efficiency? Yes. When I said that this did not happen after the financial crisis, there has been a lot of debate as to why did this not happen, and it could be productivity efficiency. Okay, so the firms could produce without hiring more people, technological advancements that happen, more use of robots and artificial intelligence, and that's why it did not happen. And that's why I was cautious about using the labor market variables as the one signal, and the second principal component that combines, okay, in a mechanical way through extracting principal components, the information from the macroeconomic variables did not have that effect. The correlation does not change sign, while with labor market variables and CPI, it does change sign. Okay. I'm sorry? Labor market, so not unemployment, but the employment rate. Well, I do not, is it one of the 125? Yeah, if we could, I don't know if we can easily switch.
The state of the labor participation
Yeah.
remains relatively high, and this is probably
Low, remains low in the U.S.
No, it has not. It has not. It has not increased. It has not been increased.
Correct.
You know, as expected.
Yes.
And this is probably because of technological efficiencies. And
Yeah. Yeah.
So that's what I'm saying. Maybe
Yeah. So
might
let
be
me see.
a way to.
The U.S. government makes a big deal out of the unemployment has dropped, but as we all as economists know, the unemployment rate is the percentage of unemployed amongst those who are looking for a job, and a lot of people have despaired, so it's not a good measure. I mean, I use, that's why I use earnings per hour. I don't use unemployment. If we are going to use an employment variable, it should be the percentage of the able-bodied between the age of something 20 and 50. I don't mean to insult people above the age of 50 here, including myself, but somehow we do not count in that statistic. But anyway, that's employment. That's all the economists talk about employment rate as opposed to the unemployment rate. Now, in that grouping of labor market variables, we should have, one of them must be the employment rate. And so all of them have, that grouping has a high correlation with the price-dividend ratio. Whether that particular one has the problem that the correlation flips sign, which is I think what you are asking, I do not know, but it's something definitely worth checking. Yes. So I think we addressed, okay, so you want to magnify the next one so that everybody can see it? Okay. As dividends are smooth, why not just try to match the price-earnings ratio? And two, what is the economics behind the magic of the second PC? Okay, So there's two separate questions. The price-dividend ratio is driven primarily by the numerator and not the denominator. So whether we use dividends, smooth or unsmooth, or earnings, I don't think that will affect it. Okay, so I have not tried it, but that's worth trying, yes. The problem with dividends and being smooth or not is when you try to match the moments of the dividend by itself, okay? The autocorrelation of dividend growth. And so that, that smoothing will make a big difference. If you smooth them, then that gives the artificially high autocorrelation. I think it was 0.45% as opposed to the model that implies a much lower one. So I think the smoothing affects the, not the mean, but the variance and the autocorrelation of dividend growth. But I don't, I don't think that affects much the price-dividend ratio. We use a price-dividend ratio because, frankly, I don't, as you all know, suffering through journals and waiting for 2 years in rejections. We started this project some time ago. So why at that point I coincidentally we had the price dividend as opposed to the price earnings ratio? It'll be very easy to do that. That's a good question. But I don't think that will change the results much. I think that the variability, the observed variability of the price-dividend ratio is matched by our model, and if the price-earnings ratio is slightly lower, you saw both in the figure and also in the table that the alternative model produces essentially zero variability of the price-dividend ratio. So the discrepancy is so big that switching from the price-dividend ratio to the price-earnings ratio, I don't think it would change the results. Why did you not use it? I don't know. It's very simple to do that as well. But that's a good question. Second one, what is the economics behind the magic of the second? Yeah, I said, you know, it's a principal component, it's a combination of those variables, so you can sort of look into it, and we have. And it is a combination, it loads heavily on inflation and labor market variables. So to that extent, we know what it is. And it does not have the, so it corrects for the fact that the channel for inflation is through typically pressure on wages. One of the channels, the other is raw materials, say, and pickup in consumption. But somehow it corrects for that channel when it did not work out as it did in the past following the financial crisis. Okay? Okay, next one. So shall I take the top left one? Are you going to help our people in the back? Does our model take into consideration any variations in the equity premium generated by equity yields, not needing to recognize the need to amortize investment costs as required by bonds? Sean, are you an accountant? Are you an accountant? No. Look, this is an exchange economy, so essentially the production is a black box, as it is in any exchange economy, as opposed to a production economy. These considerations, what is amortized, is part of the black box, and you only look at what comes out of the black box, which is a dividend stream. Okay? Those are real numbers. So I don't quite understand. First of all, let me clarify. There are many people in the industry like to think of the equity premium as the expected or the realized, historically realized return on equity versus the return of long-term bonds, okay? Because they say equity is something that sort of gives cash flows for many periods. And bonds also give coupons and principal repayment over many periods. So people in the industry consider it more meaningful to talk about the premium between the equity and long-term bonds, okay? So I think your question sort of is motivated by sort of that definition, that context. Here in what numbers I matched were what the economists think of the equity premium, which is the expected or the realized one-year equity return minus the one-year risk-free rate. Okay, so that was the target, and that's what I have shown that it addresses. And in fact, most models do that. If I did not do directly, the alternative definition of the equity premium, which would be the expected return over the realized market return over the realized bond return, set that as the target and see how the model does. But indirectly, since in the last table that I showed, we do a good job in matching the average term structure, I think that tells me that it would match that target as well. Okay, does that answer your question? Okay, we'll talk later. All right, thank you. Next one, okay. Is the convexity of the price dividend ratio with respect to the signal PT consistent with the evidence of counter-cyclical conditional? Well, okay, this is a good question, and that sort of illustrates that here we're working with a very simple model, that we have two states in the economy. And I said that here I want to present the simplest model, two states. And I do not have the direct evidence about whether in the data we do or do not have this convexity, but I think I would like to have, as we are working on now, a four-state model which allows for more richness in the model. For example, let me tell you what bothers me about a two-state model. We have recessions and expansionary periods, and in the US, the National Bureau of Economic Research defines a recession based on labor market and consumption growth variables. Okay, so that we can have a recession, can have an expansion. Now, we have the phenomenon which is correlated with that, but it's not the same thing, of the markets having high or low return. And these two phenomena are not identical. We can have a stock market crash without having a recession, and you can have a boom in the stock market without having sort of a coming out of a recession. So the two phenomena are not the same. And what we are trying to capture now is the distinction between these two phenomena. We have the business cycle, and you have the cycles of the markets going up and down. And these two cycles are correlated, but they're not identical. And a two-state model is blind to that. And we should be having more than two states in order to be able to address this. Okay? So in that sense, first of all, I don't know what is the exact shape of the conditional volatility as a function of the price-dividend ratio, whether it is convex or linear or even monotonic. I do not, what the data says, I do not know, but I cannot address that. The targets in the estimation and what we consider sort of successful or unsuccessful was based on unconditional model. This conditional volatility, I did not look at. We should be able to observe it. Maybe, Andrea, you can tell me, and Alessandro, what is in the data? What is the, if I sort of plot the conditional volatility as a function of the price-dividend ratio, what is in the data? I do not know. If someone knows, please let us know. Okay. The question is, so is first of all, is it consistent with the evidence of counter-cyclical conditional volatility? I mean, what we know is that in a recession, the volatility is high. In good times, the volatility is low. But what is sort of, that we agree, and that's what we have. But whether it is monotonic, whether it is linear, whether it's convex, I do not know. I was asking if anyone can give sort of has looked into that. I mean, it's very easy for anyone to go and check.
Yeah, we had in mind the idea that the price-dividend ratio reacts more to bad news, when the state variable signals a difficult moment for the economy. So we have this idea that the PD ratio may be increasing in the state variable that signals a good situation for the economy, but is actually concave in the state variable that signals the situation.
The model implied is that it's not, the model implies that it's non-monotonic, yes.
Exactly.
Okay, so that's what the model says. So I was asking if anyone knows what that plot looks in the data. So whether is monotonic or non-monotonic in the data. I don't know. And I guess you are not telling me that you know about what the data says, correct? Yeah.
Say of Veronesi 2000 paper, where he shows that the price-dividend ratio is concave in the signal that represents the state of the economy. So when the economy is in a through, then the PD ratio is more sensitive to shocks, and so this is, so conditional volatility is high there. Whereas when the state variable signals a good situation for the economy, the PD ratio is less sensitive to shocks.
You're saying that this is what a model implies. Yeah? No, what I was asking is, what does the data say? That's, I mean, that's a very good point, and it's very easy for, I mean, you can get the conditional volatility based on higher frequency data or through the VIX, for example, and sort of plot that against the price-dividend ratio of the market, or as someone said, the price-earnings ratio. That's very interesting. I have not done it, but you can. It's a good point. Okay. Next one. Have you tried empirically testing the nonlinear relation? Actually, no, I have not. Yeah. But I mean, people do not, yeah, I mean, it's easy to just add a quadratic term, right? You know, when, yeah, I was not, also, you know, you open a new can of worms. This is not a whole literature on prediction and then the price-dividend ratio and why didn't you use a bunch of other variables and why did you use linear and not non-linear regressions. We are not sort of, that was not of primary interest, but sort of, it was sort of kind of curious. I was surprised that the model implies a non-linear relationship. But I have not addressed it. That's something interesting to be addressed. Okay? 2 votes. David shows heterogeneous agents learning and disagreeing on regimes can match equity premium with the risk aversion being lesser. Yeah, I mean, David and Veronesi, I was referring to them in the literature review, have done important research on learning models. And having disagreement, can match. Yeah. I mean, as I said, by now, since the equity premium puzzle appeared, more than 20, 30 years ago, many models address that in different contexts. And they address it by having disagreement on regimes and the risk-free rate. But by now, we have sort of been sensitized to sort of new challenges. The real term structure is not downward sloping, and the variability of the price-dividend ratio and the whole low correlation of the price-dividend ratio with consumption growth. And I was focusing more on those. I do not know, I don't recall whether David's paper addresses those additional challenges. So what is the role of risk aversion and intertemporal elasticity of substitution in their model or in my model? In their model, I don't know. I don't remember exactly whether they had Epstein's preferences to begin with. In my model, having the proper relation between risk aversion and intertemporal elasticity of substitution is important. You need, based on the combination of those two, to say that investors have a preference for early resolution of uncertainty. Therefore, for persistent shocks that have implications in the long future, they find highly undesirable and therefore demand a higher premium. That's sort of crucial in my model, the model I presented today. Whether that is crucial for the David model, I do not remember. I do not even remember if they had power utility or Epstein's preferences. Does someone remember the David paper? No. My paper. Well, okay, good, because I don't remember things 10 years ago. For my paper, my paper with Anisha Ghosh, having the elasticity not being the inverse of the relative risk aversion, the relative risk aversion coefficient is crucial. I mean, if they have the right relationship, then the Epstein-Zinn preferences collapses to power utility. And power utility would not come close to addressing this. We do not sort of show that here, that if I were to do the same thing, the second principal component signal, but have the power utility, we may have tried it at some point, and we concluded that it does not work. First of all, you know that all the models that do not have Epstein-Zinn preferences cannot address the tension between the equity premium and the risk-free rate. Okay? Either you have high risk aversion to explain the equity premium, which means that the interest rate is very high, or you have risk aversion to address the low interest rate, but then the equity premium collapses. Okay? So based on that, we did not even try in this exercise to sort of look at the special case of this, where we force the Epstein-Zinn preferences to collapse to power utility. Okay. I know those Epstein-Zinn preferences are nasty. When I teach them to my students, it's sort of, I still don't find them 100% intuitive, but if you are going to build this kind of models, I think it's more or less essential these days to have, to separate the elasticity from the risk aversion coefficient. Okay? I think there are no more questions here. So before I end, I would like to also thank John Dugas for so many years doing such a great job with these conferences, and the local organizers, Ettore and Elena, and the whole committee of people, I assume, that worked, and the sponsors, particularly Mr. Trezzi of this lecture, for organizing a great conference. Thank you all.